All right, let's talk Constellation Brands, ticker STZ. They just had their Q2 earnings call, and wow, what a roller coaster. At first glance, you see a pretty nice earnings beat. You'd think, hey, that's great news. But as the market found out, there's let's just say, a much murkier story brewing just beneath the surface. So let's get into it.
So here's the headline number that got everyone's attention, at least for a minute. They beat Wall Street's earnings estimates by a solid 26 cents. I mean, in this kind of economic environment, you see a beat like that and you think, okay, they're navigating this pretty well. It looks like a clean win.
But the stock market has a way of sniffing out the real story. And that initial good feeling, it didn't last long because there was something else going on.
And boom, there it is. Revenue dropped a massive 15% year over year. I mean, that's not a small dip. That's a crater. A number that big just screams that something is wrong, and it points directly to some pretty serious issues with demand.
So what you're looking at here is the core conflict of the entire quarter. It's what we call a beat and bleed situation. On one hand, you've got that shiny EPS beat and management saying, hey, we're sticking to our full-year guidance. That's the stuff that makes a stock pop initially. But then you look at the other side, and that's the bleed. The revenue just fell off a cliff, down 15%. And even more importantly, look at the beer depletions. That's the real measure of what's selling to actual customers, and it was down almost 3%. This right here is the whole puzzle the market was trying to solve.
Okay, so with numbers like these, management had to come out with an explanation, right? And they did. They had a very clear story they wanted to tell on the earnings call, and it basically boiled down to one big culprit, the macro environment.
Yeah, the CEO, Bill Newland, he didn't mince words. He came right out and said it. Look, 80% of their consumers, and that's both their core Hispanic demographic and non-Hispanic customers, are worried about the economy. Their whole argument is basically, hey, it's not our brands. People love Modelo, they love Corona. The problem is our customers just getting squeezed right now, and they're cutting back.
And this really gets to the heart of the entire earnings call. This was the central debate. On one side, you had management just hammering this idea that these are all temporary, cyclical problems. The consumer is down, foot traffic is soft, but it'll come back. But then, the analysts, they started poking holes. They asked about bigger, scarier, more permanent or secular threats. What about GLP-1s, the weight loss drugs? What about people choosing cannabis instead of beer? Are young people just not drinking as much anymore? So the real question becomes, is this just a bad storm that'll pass, or is the entire climate changing for the beer industry? Huge difference.
So, facing all these tough questions, what's management's plan? Well, they're basically saying, we're staying the course. It's a three-part strategy. First, they are not cutting back on spending. No way. They're plowing ahead with a massive, over $1 billion plan to build out more capacity in Mexico for the long haul. Second, they're actually increasing their marketing spend. While other companies might pull back in a downturn, they're doubling down on brands like Modelo. And third, they're continuing to lean into the premium stuff, selling off their more mainstream wine brands. The message they're sending is crystal clear. We are not panicking. We believe in our brands, and we're playing the long game here.
So that was management's pitch. They laid out their case. But what did the market think? Well, let's just say it wasn't buying it. Not at all. The reaction was basically a huge vote of no confidence.
And just look at this chart. It really puts the pain into perspective. Year to date, the stock has gotten hammered, down a whopping 42%. Now compare that to its peers in the consumer staples sector, which are only down about 3.5%. And the S&P 500? That's up almost 17%. So this isn't just the market dragging it down. This is a story of massive underperformance.
And you can actually see the market's total confusion playing out minute by minute on earnings day. So right at the open, the stock shoots up over 6%. That's the reaction to the headline earnings beat. But then, people started actually listening to the call. They digested that revenue number, the depletion trends, and all that early optimism just vanished. It completely faded away, and the stock ended the day barely positive. That's a textbook pop and fade, and it's a huge red flag that investors are seriously spooked.
And it's not just the everyday traders who are skeptical. Wall Street analysts are basically sitting on their hands. You've got major firms like Morgan Stanley coming out after the call and saying, yeah, we're sticking with our neutral rating. They even cut their price targets. When the pros are doing that, it sends a really clear signal. Don't expect a big turnaround anytime soon. Nobody wants to be the hero calling a bottom on this one.
All right, so that's the story so far, which brings us to our take. What do we think happens next? Let's dive into the next call.
Look, for this story to get better, we need to see some actual positive signs. So here's what we're watching for. First, the holidays are coming up. How does that data look? Are people buying beer? Second, and this is the big one, what happens with those depletion numbers? Can they at least stop the bleeding? We're looking for any sign that a bottom is forming. We'll also be keeping an eye on that Mexico expansion and for any real details on this new cost savings plan they mentioned. Any one of these could be a catalyst to change the story.
Okay, so before I give you our official rating, I just want to quickly define what we mean by market perform. It's basically a neutral call. It means we think the stock is probably going to do about as well as the broader market. Not spectacularly better, not disastrously worse. It's for stocks that seem kind of stuck in neutral for now.
And with that, here's our call on Constellation Brands. We are officially rating the stock market perform.
So why the neutral rating? Well, it's a real tug of war. You can't deny the company has amazing assets. The brand equity of Modelo and Corona is just incredible, and the business still throws off a ton of cash. But all of that good stuff is being completely canceled out right now by the terrible volume trends and the fact that their main customer is under so much pressure. So until we see one of those catalysts we just talked about actually happen, we just think this stock is going to be stuck, trading in a range.
Now, given that we think the stock is basically range-bound, that leads to an interesting question, which brings us to our final segment, the trade idea.
So here's the puzzle for you. If you agree that a stock is probably just going to tread water for a while, how do you actually make any money on it?
Well, one strategy that's built for exactly this kind of market perform scenario is called a covered call. Here's the basic idea. You're trying to make money off the stock's volatility and just get paid to wait. So here's how it works. You buy 100 shares of the stock. Then, at the same time, you sell one call option against those shares. What's the point? Well, you get to collect the cash premium from selling that option right away. It's instant income. Now, the trade-off is that you cap your upside. If the stock suddenly takes off, you'll miss some of those gains. But it's a strategy that perfectly matches a neutral outlook. You're generating yield while you wait for a clearer picture to emerge.
And of course, this is not financial advice.